Hello, everybody, and welcome to week 10 of 2026. This is my print hash, as always, with myself, Cameron Otsuka, and with my co host here, Matt Dines. We've got a lot going on in the world today, but really what we're trying to focus on through this episode on our overall narrative is the last couple of weeks and last week really have shown a teardown in kind of global trade going back to the old world. And I want Matt to go deep on what's the situation in Iran, kind of how we got there, and how that fits into this broader framework. But we're also going to touch then on some comments that the Treasury Secretary made in a capital markets roundtable in our two topics for this week. So a little bit different from previous weeks, but I think each topic individually is so juicy that we're going to want to spend a little bit more time than normal on each of those. So Matt, let's focus first on Iran. I think we're all really focused on the military strikes. Who's getting taken out, where they're hitting, what type of missiles people are using. But really, the maritime insurance angle, I think, is the trade routes that are built upon those are the ones that are the key story here. So Matt, kind of take us through the situation and how we got here.
Yep. So key point, Cameron, you hit the lead. My takeaway on what just happened in Iran, I'm not focusing on the front page headlines that, if it bleeds, it leads, right? For the last 500 years or so in the European world of international trade that's been built up. We talked about the land-based Silk Roads being outcompeted. They become non-viable economically with the advent of maritime trade. With first the kind of the Spanish Empire, then you transition, to the Habsburgs, ultimately giving way to the Anglo-Dutch framework and the British Empire, which has dominated. My take on what we're seeing with the cancellation of the marine insurance policy, specifically over this war risk, is in essence an admission that these trade routes and then the infrastructure that supports them are no longer economically viable, and we'll get into that. I think there is some framing that this represents kind of a business takeover of kind of the U.S.-led, new senior partner of this Western coalition that's taking place. Kind of a foreclosure of someone's legacy franchise. I don't know necessarily that it's that, in a sense that it's a it represents like a hostile takeover type of situation, as opposed to kind of an old asset that's been fully depreciated. So, maybe this thing was like buying Sears in, 2014, 2015, where you still saw hedge funds, noticeably like Eddie Lampert, throwing, good money into that asset, that trade. I don't know if this is salvageable at this point. This may be, Sears, and maybe the next thing to get on is Amazon as the horse to ride. So that's what you're looking for. So first, let's get into it. Like, what happened? All right, we all know Friday night, Saturday morning, the strikes just it's go time. Operation Epic Fury commences. The missiles fly into Iran. Missiles fly out of Iran. They hit targets all across the Arabian Peninsula. We don't have a spray chart for the maps, but they hit not just Israel, who conducted the attacks, and not so much on the naval assets that we talked about building up in the Persian Gulf, although there were attempts there. But you saw, I think the biggest surprise that hit most people was actually kind of the profligate, just spray of fire on Iran's peers or fellow neighbors on the Arabian Peninsula. So everybody saw the headline or the photos on social media. Hotels in Dubai getting hit, military bases in the Gulf of Oman. Was it Fujairah? Anyway, just
Something
naval
like that, yeah.
ports on the Gulf of Oman, which would service kind of the naval footprint or naval forces for servicing, reloading, et cetera, potentially in the region. You saw other hits in Saudi Arabia. Where else am I? Iraq. But basically, it was just kind of profligate spray, which kind of expanded and angered the our other parties involved in or who wouldn't have otherwise necessarily been eager to throw their weight into this conflict that has taken off. in response to that, I think that the main story from a financial market angle, besides just the spike in energy prices, the bottleneck now that is represented in the Persian Gulf as far as energy exports, both oil and LNG, to the rest of the world for demand markets. So Asia and think Asia and Europe primarily. What we saw really in response was the cancellation by these international group providers who provide P&I, political and indemnity coverage for this specific type of war risk, which would cover damage to hull and machinery. So think about like missiles hitting a ship. This would be the insurance policy to um, essentially make you whole as the shipper for losses of your fleet itself. Um, so that risk really was essentially pulled like what this actually represents in my mind is a market failure. We'll look at an analog of the tanker war in the 1980s, where you had the closest thing to a copy paste situation that we found ourselves in this weekend. And this was coming out of the Iran-Iraq war in the 1980s, as basically that war was just it was a meat grinder, stalemate. Both sides were throwing resources into it,
I know you're going to
and
go deep
and
on
neither,
that, so we should definitely maybe should we
yeah,
flip to those slides and you can start talking through the tanker
yeah,
war piece. Yeah, let's do that.
yeah. Let's go there. But anyway, let's go back one just to before we do that. Cover what's the band-aid solution that the Trump administration threw out. We saw this tweet where Donald Trump or President Trump uh, notifies that he's ordered the United States Development Finance Corporation, or the DFC, to provide, we'll say at a reasonable price, political risk insurance and guarantees for essentially maritime trade and energy exports traveling through the Gulf. So because the maritime insurance industry primarily operating from the western side out of Northern Europe. It's mainly London and Norway who are involved here. Then you've got the other side of this market, or the competitors would be mainly out of Asia, right? So we'll just leave that aside for now. But basically, this is in my read on this. This isn't necessarily a takeover of someone's profitable business franchise. All of these insurance contracts are essentially going to be written at negative expected value, or like we can't charge a premium high enough to make these things actuarially profitable.
Right.
So what you have is the insurance industry and private risk capital pulling out of the market, and the only backstop here to keep this whole thing from falling apart is for the DFC to come in. What is the DFC itself? This is actually coming out of the Build Act of 2018, which was a Trump administration one kind of counter to China's Belt and Road Initiative, right? As this whole process, this resource war, trade war, all of that started to, I mean, it just entered the first inning, really, is what we were in back in 2018. Few of us realized it yet. This thing is now being used to backstop, like essentially an insurance operation, if you will, or an insurance market that is underpinning and making possible these trade routes, which no longer look economically viable, potentially, in my opinion. And the longer this goes on, the more that becomes a certainty. All right.
Yeah.
So just to go through this tanker war background, Iran-Iraq War, 1981 to 1988. As I said, this thing was just a meat grinder. Neither side could prevail against the other. And eventually what you had was each side started attacking the tankers, like oil exports of the other, to basically raise the bar, the cost, uh, and essentially lower the economic viability of the other side's oil exports, which were entirely funding the war effort of both sides. Um, What actually happened here? All right, just compare and contrast. On the left column, we got just a couple of or just a list of dimensions of these two situations and how they compare and contrast. I'll give the spoiler. 2026 is like an order of magnitude bigger, maybe two, like on every dimension versus what we saw in the tanker war. They list 1987, 1988, but it was like an escalation throughout all of the 1980s until it came to its head. All right. So what happened? All right. Number one, why is this time different? I would say the biggest thing is the asymmetry in cost to attack versus defend the trade routes in this point. So in the 1980s version, Iran and then Iraq to some degree, acting on the opposite side. Um, the vectors of attack were missiles, mines, and speedboats. We were able to defend against those relatively easily with naval convoys, right? This time around, we have this is drones in terms of and like fifth generation warfare. So on top of all those other kind of attack vectors or weapon technologies, drones are the kind of the differentiator here. You've got a much lower cost structure to wage an attack and a much higher cost structure to compete with that in terms of missiles or counter
Right.
technologies to defend. Um, so because of this technology advance that has tilted the playing field towards the attacker in the span of 40 years, we've seen we call this Lloyd's is the firm through its joint war committee selects these zones that are war zone, essentially carve outs where the insurance policies are not valid. Right. So in the 1987 version, besides just that Persian Gulf, you had the Gulf of Oman added, which is just kind of, if you think about it, it's that intermediate mouth. You go from Persian Gulf to Gulf of Oman, and then you get into the blue ocean of the Indian Ocean, where it's much harder for the attacker to wage their attack, right? But this time around, you've seen an expansion, not just some stretches in the Persian Gulf and Gulf of Oman. Now you've got in the 2026 version we just saw this week, you had Bahrain, Kuwait, Oman, Qatar, and Djibouti added to the JWC zone
It's a
expansions where
huge
this
zone. Yeah.
cancellation of policy take place. Basically, it takes out all the oil production
Yeah.
regions and also the trade routes in between where you have to traverse to get to safety. So it makes your task as the supplier much more challenging to get out of the attacker's radius. And then here's the key thing: the peak war risk premium. And in the 1987 version, the insurance market was able to clear. Um, you had a surge pricing, if you will, and at the highest level, it was 7.5% of your value of your hull and machinery. You can also insure your cargo as well. But basically, you peaked at 7.5%, which take the reciprocal of that, basically like 1 out of 12, roughly. So long as you're not losing 1 out of 12 tankers here, you're going to break even from the insurance standpoint. What what the U.S. intervention did in between that was essentially they did some military reflagging of the vessels, but then they also provided a naval escort, and then they just convoyed the supply chains out of there. And that combination of price plus the relatively low cost of defense in terms of just it was the naval cost, right? You got to pay for the U.S. aircraft carriers and all of that to provide defense for the oil exporting suppliers to get their cargoes out onto the blue seas. The market could clear, right? This time around, however, the insurance industry say there is no market price that we can take these to get the market to clear. And then the proposed U.S. intervention here, the band-aid that we're going to try to get to make this market clear. Number one is the DSC takes over the political risk insurance. And then we've also proposed the naval escorts. It's TBD just based on the cost to defend yourself against the low cost of attack from drone technology, if we can make this economically viable. But in my read, the fact that the P&I insurance from these 13 groups essentially make it up. They're mainly in the UK. Second would be in Norway. I think you've got one group, it's called the American group, and then one from Japan that makes up this kind of private capital pool that um, basically insures and
Keeps this whole thing
covers this
running.
risk.
Yeah.
Yeah, they've backed off, right? And so this is a multi-billion dollar market. To do this, you have to have kind of you can't just go into this without like training or building up years. This is centuries of expertise that has been built up within the insurance industry, understanding relationships, instead of knowing how to price risk. This idea that Washington D.C. through the DFC and the Build Act can just kind of overnight spin up and know what they're even doing here, being competent at this is it's kind of a stretch,
Definitely something we need to
right?
keep watching. Yeah.
Yeah, so I think that the degree of difficulty, like this is a triple axle back, I don't know, just making figure skating, Winter Olympics analogies here, but it's the degree of difficulty is very hard, in my assessment, to keep this thing humming along. And when I say this thing, what do I mean, right? This isn't an American franchise. If you look at number one, the regional fleet of just global ships, and this is according to an IUMI research piece. They cite as a source here Clarkson's research. This is the just global fleet of just shipping vessels. It includes the oil tankers, LNG tankers, all of that, but it includes your ships, your Suez Max, Panama Max, all of that are just hauling shipping containers. So it counts in here more than just oil and gas shipping vessels. But it's very clear from this graph. You see the expansion since 2000, the start of the 21st century. You kind of saw, yeah, the I grouped together all of the Asian countries. Light purple is other Asia, pink is Korea, green is Japan, red is China. Those just aggregately call this the Asian market. Blue is European, and then the gray is Americas here. The American fleet, the Americas, I think this would count the whole Western Hemisphere, but most of it is going to be just the dominant economy here, U.S. You notice the story here. The international fleet is really the growth is in the Asian market. They are becoming dominant here. The old world fleet and the trade routes, everything we've talked about on our weekly episodes the last few weeks, starting with Columbus, setting sail in 1492 to find new trade routes to make kind of Western Europe more competitive on trade versus Eastern Europe, which was kind of, Venice was the power center. That kind of window of history, all of this, international trade, economics, and finance that have built up since then, you've seen the European footprint there stagnate, especially since COVID. So in terms of this market, you're seeing a shift in power away from Europe and kind of the legacy operators for multiple centuries towards the Asian competitors, right?
Yeah.
In my opinion, that is the backdrop of this story as we're seeing it kind of play out, including this weekend with a major development. Um, all right, now you get into the insurance market. Without the insurance, um, without an insurance industry to backstop your trade, none of this trade will happen, right? It just is not viable. And you see which markets are actually consuming the most of the insurance kind of segment of global capital markets. Europe, I'm following the left graph here. Europe is the leader here. It's consuming most of those capital resources. Asia is in the middle and it's trending up. And then you see Latin America and the US, it's a tiny footprint in terms of what it's consuming. So think about this like, all right, where is the European trade? Like technically it's everywhere, right? European routes, we showed these charts last week. You got the port of Rotterdam, which is the main port in continental Europe. You've got trade links there going to the Western Hemisphere through the Caribbean, connecting to the U.S. They also go, through Gibraltar, through the Mediterranean, up to Persian Gulf for exports. Then they also continue through there, over into Southeast Asia. Europe is the middle, like it connects everywhere. And so it's eating most of the capacity here in global capital markets. Asia, they kind of connect to both as well. But in terms of the insurance capital to protect the trade or make it go, if you will, or just make it viable, it consumes roughly like half of what European trade requires. And then the Western Hemisphere is just like a tiny fraction. Like it's both smaller and the growth market, in my opinion. Um, but it's also much easier to defend, right? The main kind of conflict point, and this goes back to like, I don't know, the movies Pirates of the Caribbean, Treasure Islands, et cetera. You gotta defend against piracy in the Caribbean Sea, right? That's the challenge. But with the existing US Navy, it's relatively easy to do. And we just showed it in Venezuela.
Right.
We essentially police that area and we have it on lockdown. All right. All right. So you look now at the market footprint for insurance, right? And this is why I say, is this even a good market? As a lot of people who view this as like a conflict between the U.S. and the upstarts in the Western Hemisphere versus the old world and like primarily in Europe, and this era is really a conflict between those two duking it out. There's a bigger picture to that context. My point is, why would you even want to foreclose on that empire, right? There's been some framing of what we saw this week with the cancellation by Lloyd's. Instead of viewing it as a backstop by the DFC to just keep this whole thing from collapsing upon itself, aggressively, like a full demolition, violent, etc. You know, put some support beams in place, reinforce it. It's going to decline, right? It's an asset that's not long for this world. But you don't want to see this thing in a complete demolition because that's
Right.
going to hurt like the collateral damage there is going to hurt everybody.
That's a key
So you
point
look
for
at the
everybody
market
there,
share.
right? I think
Yeah.
when I first saw this DFC post come out from Trump, I thought immediately this is just backstopping. We have no other plan on this. But to your point, it's making sure that as this comes down, that we're putting the structure in place to make it a controlled demolition in a way.
Yeah. So you see the premiums, North America accounts for 4.3% of whole, cargo 7.5%. This is just show like the Western Hemisphere and even the US as the largest mark-to-market economy in the world still today. It doesn't consume a lot of resources in terms of global capital to secure its own trade, right? And then all this trade we've been talking about, just connecting the dots between, say, U.S. Argentina, U.S. Venezuela, U.S. Mexico, can't whatever, USMCA. It's much lower cost. It has a competitive advantage versus this old world kind of framework that we'd be looking to defend. So why would you even want to take this thing over as opposed to just like, hey, let's keep this problem from getting worse? That's my read on this situation. All right.
So
So some other, yeah, just barriers. Why we also in the US don't even have the ability right now. We don't have the infrastructure to port over what exists in, say London, with say Lloyd's and what it represents as a society, all these names that come in to essentially syndicate and fund risk, if you will. Number one, we don't have any like institution or just market structure that can even compete with what's been built out for 300 years. What do I mean by that? The U.S. insurance market is extremely fragmented from a regulatory framework. It's basically like state by state. States constitutionally generally have been given control of regulation of the insurance industry. So basically, we've got 50 regulators. We don't have one framework where capital from all over the United States, all 50 states, can come in and pool and then fund this maritime insurance risk. That would take acts of legislation. It would take political buy-in that doesn't yet exist. It can someday, but these are things that take years and decades, say, of compounding. You don't just copy paste this over, and have this thing move from London to New York or London to Miami overnight. There's a lot of work that has to go into the movement and shift of capital markets to basically build out the infrastructure to make a U.S. footprint viable. That will happen, in my opinion, over the course of this century, but this is like a much longer term project than most people realize. The other thing too, so like Lloyd's of London paper is universally accepted around the world by banks who issue like letters of credit for commodity trades or just the international, like cross-border capital transactions to move, say, a VLCC from the Persian Gulf, from an oil exporter over to supply, say, Japan, wherever. But that kind of universal acceptance doesn't exist yet, or it doesn't exist at all for DFC instruments. So that is a headwind. These things take time to build out. This is why networks, like, they don't port over and the value doesn't shift overnight. Generally, it's more of like a years and decades story. The other thing too is like claims handling infrastructure. We don't have average adjuster kind of headcount necessary, even existence in the U.S. labor market, probably to handle claims that will exist here, and they're getting more complex. Is kind of the background of the work as we're going through one of the hottest flare-ups, I think, in the centuries of history that has existed for this industry. And then there's just the background on courts and admiralty law, special situations, understanding war risk disputes, all of that. We haven't built up any of that in the U.S. So even if we wanted to steal this thing, if we wanted to take over Sears Holding Company in 2015, we don't even have the thing to the infrastructure to put it in, right? We don't have supply chains, logistical, fulfillment centers, all of that. So we can't even foreclose or buy up this franchise for pennies on the dollar. It doesn't necessarily make sense. So this is more in my move, like almost think of it as like a bailout. It's propping up this thing to give us time to move on to the next step. And this is, I think, where you see the geopolitical relationships, right? So Sunday night, Monday, et cetera, there was conflict with, say, Spain not going along with the Trump administration on trade. And you had other European powers as well who were like, no, we don't want this. They folded very quickly once they realized what everything means. Once they had that conversation with their industry leads who cover insurance and capital markets from their own country or whatever. Once they get that talking to, they realize really quick what the implications were and that they fell in line very quick. So if you remember, like 2008 to 2016 era, Obama, basically just international relations policy being, we're going to lead from behind. We're just going to sit back. We basically gave, in my opinion, we gave Europe 10, 15 years to mess around and try to figure out how they were going to wriggle their way out of this situation, to figure out what was next. That was all borrowed time. They didn't solve it. Trump administration coming in, V1 2016 to 2020, but now 2024 to 2028, they've essentially said, yeah, there's very clearly no leading from behind anymore. U.S. is going to dictate what comes next for the West, and everybody in Europe, you're just going to have to fall in line. And by and large, that's what they've done so far this week.
And so really quickly, Matt, just
Yeah.
before we move on to topic two, but kind of walk us through just very briefly, like Russia, and then I'm going to flip over to this next slide here. Ecuador, how does this tie in to that kind of
Yeah.
broader framework that's happening with Iran?
Yeah. So the thing with Russia, right? We talked about tanker war of 1987 versus this edition 2026. What didn't exist in the 1980s version was this uh call it like a black fleet. It's uninsured. It's not in the purview of this, insurance capital markets industry. Um so if you think like it's kind of a protection racket, right? But say compare it to the auto industry for everybody. If you get in a parking lot accident, car A hits car B, your car A in this case. If car B is an insured driver and say you're on taking a US standpoint here, if you're on Progressive, car B is on State Farm, your claims adjusters, they can talk to each other. They'll do some interviews, who's at fault, all of that. And basically, like, yeah, they'll decide who pays, which insurance, whatever, whose rates are going to go up next year based on who is at fault, all of that. But a solution is achievable. Everybody's kind of made whole. The insurance process works itself out. Some losses are taken, but risk is essentially dealt with properly. It works inside the confines of the system. What we've seen in the last 40 years, and especially in the last 5, really, since the Ukraine war, is the build out of this black fleet, which is largely oil tankers, which are transporting Russian, Venezuelan, and Iranian oil from A to B, and they're not insured. They're not covered by this legacy capital market system, which is primarily talked about for political risk, war risk. It's those 13, call it the international groups, who do the P&I war risk policies, right? In this case, you've got a growing section of the market here in this black fleet. Think about it in your car accident analogy. When an uninsured, say undocumented driver hits you, you don't have anything to go off of. There is no process. When you call, what do? You get a police report? I don't know. Do you have some security camera footage somewhere? That helps. But you're essentially self-reporting it to your own insurance. Now your insurance has no other counterparty to work with and resolve a problem. It ends up being massively costly because instead of the risk sharing being spread between the two parties who are involved in the collision, and then say their proxies who are providing the capital to backstop, say the transaction here is just driving, right? It becomes more and more costly for the insurance industry to capitalize or essentially fund an activity like driving in this case to take place. And we're having this problem in the United States, right? Same thing is happening like in the global insurance market for maritime, whole cargo, etc. And I think this
Yeah.
this article here you saw popping up. This was Tuesday, I want to say March 4th or Wednesday. We saw a Russian tanker. I think this was an LNG tanker just explode in the Mediterranean as a result of a drone attack that has been uh, basically placed on or pinned on Ukrainian drones, right? Who made him do that? Who gave him the intelligence to say, "Hey, this tanker was over here"? Well, guess who? It doesn't take
Right.
too long to figure it out. They were told this is a proxy by someone else in this big process taking place. But essentially, this is the same framework. Like, all right, your business franchise here, when all global trade is covered by one insurance or like an insurance capital market where everybody works together, they're happy, they work on good terms. You have relatively stable profit margins. The whole thing works. Now, it's when conflict breaks out, which is downstream of kind of the fracturing in the market from the white fleet or what's covered by Western capital markets. You could say Asian capital markets do some of the funding as well. But then there's the uninsured fleet. This thing in Russia is part of the problem. Now, two sources of oil there, we said Russian, Venezuelan, and Iranian. Two of the three, Iran and Venezuela, have been addressed here, or Iran is in process of being addressed. Russia is not. You can't just do what you did in Venezuela or do what we're doing to Iran. In terms of which civilization or society is going to be more costly to fight back again. Kind of rank order those. On the lowest, Venezuela was the easiest to wrangle in. Iran next, and Iran is very costly, right? It's probably an order of magnitude above Venezuela. Russia, you're not going to be able to wrangle them in with something like this. It's going to have to come to some sort of a business agreement is the only way that check gets settled. But this is kind of the hallmark what's going on. These were necessary milestones, in my opinion, to see a resolution to this lack of understanding, if you will, between business partners, between the West and Russia. And you could say even between the West itself, with a clear fracture taking place between US and Europe that's been developing. We'll see if there is a coalescence that can take place, and maybe Europe gets in line and starts listening to the US now as the writing's on the wall.
Right.
All right. And last, you saw at the same time this week, I think this was yesterday, the US opens military action in Ecuador against terrorist organizations. This is kind of that same thing. Think about this in terms of the US rolling up, those relationships in the Western Hemisphere. This is kind of part of the sovereigntist movement, that whole, the Donroe Doctrine, all of that. But this is, as an afterthought this week, news just doesn't have enough airtime to cover this, which is like, if in any normal week, this would be like the story. But think about this as basically, we talked about the Western Hemisphere and the Americas being kind of the lowest marginal cost of doing business for international trade or maritime trade. This is kind of the roll up. Same thing. All right, we rolled up Venezuela. We've got, say, Argentina flipped to cooperative. We've got Chile cooperative. We've got elections that are coming this year in Colombia, Brazil, political governance in Ecuador, Bolivia, etc., is now flipped amenable to working with the U.S. under this mindset of, Western Hemisphere only, everybody else get out. I think what this represents is this military action in Ecuador is an elimination of the kind of the adversaries to that whole narrative. So this kind of establishes for the going forward, Western Hemisphere nations trade between themselves, building up new supply chains, et cetera. This is a positive story for that. It tells you like this is the growth market. And those blocks, the Western Hemisphere blocks, they'll still trade with, say, partners that they deem allied and cooperative to their interests and respectful of their sovereignty, et cetera. Japan, Italy, you see as kind of early sweeps. But this is just, that whole process unfolding in real time, in my opinion.
Great. Well, let's move on to our second topic of the day, because again, we're tying this all back to kind of the global trade structure spanning back to the old world being kind of upended here. So the U.S. Treasury is encouraging commercial banks to do something that would upend how credit creation is done in the U.S. I think, Matt, I had sent this late last night. I found a couple of notes from Besant, but I'd like you to kind of go through exactly why this is such a big deal for the credit creation in the U.S.
Yep. This is just to cut to the chase here. This is just the sixth time. How many times does it take a message to land with a recipient to sink in, right? You say it once. All right, did you hear me? I'll say it again. Did you hear me? If I say it like 10 times, I've been saying this for the last like 5 years, eventually you expect everybody to get on the same page,
Yeah.
hit the marching orders, everybody act together. That's exactly what's happening here. So what are the marching orders? All right, this was a roundtable luncheon in Washington, D.C. held on Tuesday. Basically, the who's who was there, this Committee on Capital Markets Regulation. It was spun up by Treasury Secretary Hank Paulson in 2006, 20 years ago. As the writing was on the wall, people saw the GFC coming. They saw that there was going to have to be capital markets reform. This working group was spun up with basically the captains of industry for the financial markets as they relate to the United States. You've got the big banks from the U.S. represented. You've got all the regulatory alphabet soup. Everybody's there. You've also got a couple of international banks. So there's some Japanese bank. There's I want to say ICBC from China has a rep. You got some European banks coming in. But basically it's like, all right, how is the new credit system going to work? How are we going to regulate and get out of this? Uh, I guess um, just call it just muddy sledding that we're operating through right now, which we've really been in for the last 20 years, right? And so the paradigm that's really coming through, instead of a framework where new money creation is primarily viewed as the responsibility of the Fed. And what do I mean by that? It's like it's a QE framework, right? If the economy demands more money, we need to get more money in the economy for growth to take place, right? This is kind of the monetarist framework. It's going back to Keynesian, neoclassical economics that dominated the 20th century. The paradigm that stepped in, and this was really the central banking, that they're the be all and end all. They're the masters of the universe. That whole kind of belief structure. Basically, the policy prescription was exactly what we saw in the 2010s. The central bank is the one who has to come in through QE to reflate, remonetize, say a growth downturn in the economy to pull it out of the bust part and get back to the boom of the business cycle. All right. That whole framework has been thrown on its head. We're essentially trashing the Ben Bernanke or Japanese central banking experimentation policy view, and ECB went along with it as well. That's being thrown out the window now. And this is really represented in the nomination of Kevin Warsh, who is a balance sheet hawk. The idea here is what's going to happen. We're going to shift the Fed and the central bank back to being the lender of last resort. In short-term money markets, commercial paper, et cetera. They'll provide the emergency liquidity into the banking and financial system, through they'll create money by, say, purchasing treasury bills or short-term commercial paper. That is money creation, right? But it's really happening. It's monetary creation, not for, let's say, the government itself or not for the broader private sector economy. It's money creation for the banks. And then what this is saying is the banks need to get back to their role of lending and creating money into the private economy. So basically, what Treasury Secretary Bissett and Undersecretary Jonathan McKernan delivered in these remarks is basically just what we've seen multiple times now in releases from, let's say, the Fed, et cetera, over the last few years. We're moving the discount window. They're setting up this architecture where the collateral assets, so say a bank loan or a mortgage, et cetera, those are pre-registered. They've already been reviewed. The Fed has some data on these assets. Before the crisis, goes to DEFCON 5 or, whatever, we're in the thick of it, where time is of the essence. All of these things are pre-registered, custody channels, other encumbrances. They've all been worked out. They know these things are free and clear so that the lender of last resort can post. They know, and for the policy prescription under Badgett Classic, right? Lend freely against good collateral at a high interest
All
rate,
about
right? Or
speed, right? They
at a
know
penalty
that
rate.
these
Yeah,
meet the
yeah,
requirements.
it's speed. It's get back to that, right? We're not going to solve our way out of this by QE. So the banks can recapitalize them or access liquidity. The collateral is pre-positioned, and that borrowing, that lender of last resort placement can take place very quickly, and is not necessarily stigmatized. It's used for its exact purpose, rather than shunned. Now, then what takes place after that? The expectation is if you build out that system, then you can prod the commercial banking layer into bank credit expansion. which is actually monetary creation for the private economy. And this gets into, all right, here's money supply in the economy. It can come from two sources, right? Central bank can buy government bonds. They can buy whatever. Like you've seen examples in Japan. They're buying equities. They can buy land. Any asset, just as long as the central bank acquires it, gives money for it, they're doing that. They're accomplishing that task of increasing money supply. Um, but what we've seen in the US case, especially since 2008, banks have been reluctant to grow bank credit in the US. So that bank credit line lending and monetary expansion into the private sector is growing at 4.36% annualized. That would actually include treasury securities too and agencies. So this includes like private and public expansion. Um, the central bank balance sheet, and that's the dark blue. I don't have the growth rate there, but it's growing basically since 2008 at like 15% annualized. The point here, we're setting up a framework to basically shift those, right? We want to get the bank expanding money supply, funding growth in the real economy, and then pull back that usage of the central bank balance sheet for reflationary purposes, which I mean, you look back at the last 10, 15 years and you see, all right, what projects did that fund? Software, SaaS,
Yep.
all of that, private credit. You're seeing a lot of that, like that's getting liquidated right now.
Yep.
A lot of that was bad debts built up. And so that monetary expansion, the debt for that went to non-productive uses as it's turning, or a large share of that went to non-productive uses. Um, Instead, right, with this new framework that this administration is pushing is going towards reindustrialization, build out of infrastructure, et cetera, commercial lending. We talked about this in the H.8 data, but this whole pivot, this re-architecture, basically this thing, like we got all the who's who together. Treasury Secretary, basically, Treasury Undersecretary, basically delivered, guys, let's do that. Like we're doing this. So it's kind of that standpoint. How many times do you have to say something before someone understands and everybody gets on the same page? Well, everybody's heard the message now loud and clear. And you kind of got to expect everybody's going to start, falling in line behind, I guess, Treasury Secretary Bessent as the guy who's calling the shots. And this is the path we're going with. All right,
Yeah.
last story, Cameron. Let's get to it. Big news. This probably only was picked up on the radar of the Bitcoin space, or we'll include the crypto bros as well if there's any of them left anymore. But Kraken received its permission, or the green lighting, if you will, to register and open a master account with the Federal Reserve. So it's its regional branch. The Federal Reserve Bank out of Kansas City. So the way this works now, why is this important? From a plumbing and infrastructure standpoint, what this means, instead of Kraken as an exchange now having to work through one extra hop here in the domestic dollar financial system, in the old world, before it had this charter for the Federal Reserve Master Account, to transact and settle in dollars, it would have to go through a commercial bank intermediary, right? A third
Middleman.
party.
Yep.
Yeah. And to basically to provide that banking service to a party like Kraken, a crypto exchange, right? They had to fund this through their own balance sheet. And essentially, they're operating a toll road to ultimately access the dollar system rails. How does that materialize? Well, think about a transaction settlement. You're buying, selling crypto. If you're an institutional borrower, right? If you want to move dollars from your Kraken account, those IOUs, move them to another brokerage to go buy, I don't know, Google shares, whatever. You've got to do hops, right? You got to move through the dollar financial system. The banks, their commercial banking partners, were charging a toll to access, those roads, if you will. So you think about this moving through FedWire. I've seen wire charges of like 10, maybe even as high as $25 to do a wire transaction. all you're doing there is settling on the Fed wire dollar. For a bank, that I've seen estimates that to conduct a wire, essentially, get on Fed chain. Um, that transaction can, like, they're very low price for the Fed makes it very low price for the commercial bank. So they can be as low as 3 cents, as high as, like, I don't know, maybe a dollar to conduct a transaction. But the markup there, that's bloated out 10x or 25x for a crypto firm like Kraken, um, to access those dollar rails and interact with the rest of capital markets. What it ultimately results in is non-competitive cost structures for Bitcoin or crypto industry firms. Case in point on that one, Cameron, I think you put it up here. Fold. This is a Bitcoin financial services company. That basically, it's just focused on giving rewards to customers who use, the Fold debit card for their daily, I got big dollar transactions, right? And case in point here, you look at their income statement. 2025, this is first 9 months, ended September 30th. So Q1 through Q3, $22.6 million in revenue. The banking and payment costs were 20.9, almost 21 million of that. So if you think about this on your gross margin structure, 92 and a half cents of every dollar you earned is basically just taken over by the troll who's operating the toll road, right? It is very hard to do anything as a business to get by that troll. Like Cameron and I, we're running a private sector business. Like, if you have, like, we have our own kind of trolls in the asset management, broker dealer complex, all of that. It is what it is. But if if you're if you're paying 92 and a half cents of every dollar, or 2024, same period, it was 94 cents, even worse. It's really hard to build up, net income, reinvest in the
Yep.
business, and grow. So this kind of, I guess, we'll just call it restraint of trade, blockage, lack of plumbing access for the Bitcoin and crypto industry. This was extremely costly, right? So the Fed, through the Kansas City regional branch, green lighting this. In my opinion, what they're saying, um, number one, the U.S. from a financial system perspective, they're not going to simply let banks just sit idle, rest on their loyal laurels, and rent seek through this little period. I talked about this growth patch we've been in, this soggy patch, tough mudding since basically 2008 in the GFC, and capital markets volatility. Talked about everything going on in international trade, right? When you see all this risk going on, what you want to do is just sit back. It's like, I just want to survive, right? Um, the US kind of regulatory structure, the Fed, political and governance, et cetera, everybody's now kind of, you're seeing them align that the legacy banking model, call it banking classic, is number one with that Besant story we highlight on. They're going to have to lend into risk. Like, they're going to have to capitalize this growth. That's the only way out of this. And that angle that will ultimately lead to, like, more capital provisioning to the domestic U.S. economy, even its Western Hemisphere partners, who it wants to build up those primary and direct trade relationships with, and then its cooperative partners from outside the Western Hemisphere. That's the focus now. And then from a technology angle, um, it's basically saying, like, banks and the legacy system are going to have to come along and adopt what this crypto phenomenon is actually pointing to. And once you feel out the elephant in the room, right? If you look at Kraken, what does its business amount to? Number one, you've got the FX trading pair for the spot market, Bitcoin on chain, on the heaviest chain. Bitcoin is unique in what it offers as a digital asset, the solution to the Byzantine generals problem. We talked about that before. That's your primary business, right? You get into Bitcoin is what the market is saying at once. But number two, it's alternative chains, and what they represent. What is their value prop? They're just running the stablecoin rails for the tokenization of U.S. dollar bearer claims, right? And then underneath stable coins, what's actually the thing pulling itself up by its own bootstraps? Well, it's the treasury bills that are going to be plugged in. So now you're going to have a treasury as a monetary issuer in some regards, like the Civil War greenback, that'll probably compete to a high degree with the Fed's bank dollar framework or a credit dollar framework. Those two things will have to compete with each other in the years and decades ahead. Um, but then what they're really accessing is the kind of that liquidity pool in the spot pair that Bitcoin represents. So that's what's going on. Stories 2 and 3 focus on the US angle of the build out of the new world. This is the hot business franchise that I think if you're putting it in that Sears Amazon analogy of the 2010s, which that's where Cameron and I met each other. Everybody, to tell you the backstory, Cameron and I met. We were building out the advertising kind of ecosystem to bring vendors onto Amazon's platform. Um, all right, this thing in the Western Hemisphere, the Don Road Doctrine, the new financial rails, the new trade routes, all of that. That's the new sexy growth startup. Your old world, everything we're seeing, international trade, breakdown in maritime insurance risk markets. That's your Sears, in my opinion. Um, what's the right move? Cut your losses. Stop working on Sears as soon as possible. Stop throwing good money after bad. A lot of smart money made that mistake. Eddie Lampert, etc. But that's the big picture of what's going on, and I think this week was just a key development in that big picture that we see playing out that we keep talking about on a week to week basis.
Absolutely. Well, as always, thanks, Matt, for sharing your thoughts with the audience here. If you have not already, please subscribe to us on MyPrint Hash at Substack, YouTube, X, LinkedIn. Throw us your comments. I know Matt and I love to see comments. We tried to maneuver the show a little bit, make improvements week over week. So again, definitely looking forward to seeing that from the group of you. So all right, that's it for our show this week. See you all next week.